Hello, everyone. Thank you both for joining, and thank you to our listeners for joining today. Today, we're talking with Joe Cicero and Tom Pastore, and we're talking with Joe as more of the litigator, corporate counselor, and Tom as more of the litigation support expert witness testimony around economic and financial issues. So before we get in, let's introduce ourselves. Joe, we've had a couple podcasts with Tom. Definitely listen if you haven't. So let's let Joe introduce himself first, please.
Sure.
And
My name is Joe Cicero. I'm a Delaware lawyer in Wilmington, Delaware. I've been practicing primarily corporate and commercial litigation for 23 years. I do some pre-litigation advisory and corporate counseling work as well, but primarily litigation of mergers and acquisitions and other transactions.
wow, okay. And Tom, reintroduce yourself to our audience, please.
Certainly. I'm Tom Pastore. I'm the CEO and co-founder of Sanli Pastore and Hill, financial advisory and business valuation firm. We've been in business now 34 years, and I've been doing valuations for about that longer period too. And the valuations are used as an expert witness, let's say in M&A litigation, today's topic, in actual M&A transactions, and also in trust and estate valuations.
Where numbers are not as simple and straight answers as we were taught in school by any means. So,
Certainly.
yeah, I always like to ground these conversations with who would benefit from continuing to listen to this conversation. So, who would benefit from this?
Well, from my perspective, I think transactional lawyers would benefit while they're pretty seasoned in this topic. I think they often like to hear from a litigator's perspective because they craft these deals, they do a great job, and then always something goes wrong. It's usually not their fault, but we learn a lot from the court and how these cases come out, and I think it's helpful for those folks. There are others as well, people internal to maybe private equity, people that do deals. I think that's the best folks that you could learn from this. From my perspective, Tom may have additional.
Yeah, I think it would be also investors in merger and acquisition transactions, whether it be private equity, venture capital, hedge funds. I think also business insurance professionals that offer representation and warranty insurance uh, could benefit, as well as my colleagues that are expert witnesses in financial damages.
Wow, there's a lot of people that deal with a lot of money there, so that's super important. And what is worth what? So we're mainly going to ground the conversation in two different areas today. We're going to talk first for the listeners that to know about misrepresentation and fraud and representations and warranties litigation, things like that. And then we're going to move into earnout cases, incentives to the buyer, things like that. So to kick off this first topic, what is representations and warranties R&W litigation? Can we have a base definition?
Yeah, I mean, representations and warranties are essentially what both buyers and sellers list in a transactional document, whether it's a merger agreement, a stock purchase agreement, or some other M&A transaction agreement, where they usually a buyer or seller is warranting certain, items about the company that they're selling, that the financials are accurate, that there's nothing troubling in the marketplace or from a regulatory perspective. And they make these representations and warranties specifically within the four corners of a contract. And, post closing, often there are issues that arise that lead to litigation. And that's really what reps and warranties litigation is. I mean, boiled down, it's really a breach of contract type case, but it's specific to this type of atmosphere. And then fraud is just that extra layer of intentional, you know, falsity and, by the person making that representation.
So intent matters in this situation. It couldn't just be blissful ignorance about your finance, but
Well,
intent.
with respect to a claim of fraud, it matters. With respect to breaching a rep and warranty, intent doesn't matter. It's you rep something that was true, and if it isn't true, then you might be liable for that.
Mm-hmm. And what are some of the disputes that arise in this R&W situation?
There are a few. Oftentimes, you see a representation about the revenue of a company, right? Now, those are usually pretty accurate because you usually have audited financials or an accounting firm that takes a look at those and signs off on them. Where the trouble comes into play is usually the revenue is based off of whatever you're selling. If you're selling a service, or if you're selling, equipment, like I'll use an example from a case that was from last year called Duramedic in the Court of Chancery. That company was a medical equipment supplier. So if you would make a representation about how many customers you have, you would identify the significant customers, the state of affairs with respect to their contracts. And, something that could come up quite often is, you say that none of these clients, these significant customers, have threatened to terminate the relationship, or you haven't seen a material downturn in their ordering, something to that effect. And what might happen is you make that representation as a seller, and then post-closing, it turns out that a handful of those customers threatened or gave notice that they were terminating. So the rep is false.
Okay.
That's one. And then others revolve around other parts of a transactional document. And Tom could probably speak a little bit to this as well. I'm happy to chime in, but there's something called an earnout built into some of these deals usually, which is there's a part of the purchase price is up front, but then there's a trailing piece that sits out there as an incentive for the cash will be paid to the seller later based upon the performance of the company. And there are different metrics that can be used. And those are often litigated.
Okay. And Tom, can you clarify more on that? I guess it really depends on if it's company with a lot of stock, and there's two meanings of stock in this situation, of merchandise or things if it's medical supplies. And then there's also the human services of it all, like the sales reps, the company representative, things like that.
Yeah, basically the economic calculation or the valuation of an earnout depends firstly on the terms of the earnout. So it might specify on a very rudimentary level that, look, if you get X%, 20% above your targeted revenue in year 3 after the transaction, we will give you a profit margin based profit of 10% more of that. And it might be rudimentary like that. It might be more complicated. In fact, it looks like you're enhancing your value, whatever multiple we agree to in the transaction will apply a multiple to that profit, as an example.
Okay. And how often does this come up? Is this a situation when the seller is typically misrepresenting, or is it more likely that the company does better than planned and the seller didn't have knowledge of that? Or
I think
Well,
it could
I
be.
would. Oh,
Go ahead. Go ahead, Tom.
Oh, I think sometimes in what I've been involved in and as an expert is that the seller, has multiple divisions, a big company, it sells the business to the buyer, but it diverts some key customers, the seller, to its other divisions. So that earnout situation cannot occur, but that's an issue of fraud at that point, and then we come in and calculate what the earnout would be, but for that action.
And I've seen that. I've also seen the sort of what I'll call the flip side, which is the buyer now controls how well the company performs, the target company. So, and if let's say there's a trigger that they're going to have to pay a lot more money to the seller, sometimes they artificially, manipulate performance in a negative way, so they don't have to pay that earnout because that's temporary, right? They can manipulate it so they don't have to pay the earnout. As soon as the earnout period expires, they can start performing well again. And often ways that they can do that is they've and sometimes it's not purposeful, it's just, it happens, but strategy might change, the product might change. They can earmark expenses in a different way, and Tom probably seen this more than I have, but especially if there's different business units at the buyer, if they have synergies with their expenses, it's not an apples to apples comparison like it was, when it was a standalone company.
Or even, I guess, offer, let you delay your invoice for 18 months as a deal. You don't have to, or delaying payment conditions so that it's after that point.
Yeah, well, that would be an egregious example, and one that would be much easier for folks like myself who litigate these cases. If you find something like that in an email, some sort of correspondence, then that always helps the case when you're representing the party that wants, that believes it should get the earnout payment.
And then let's
Yeah.
talk. Yeah, please, Tom.
Oh, and often from an expert witness standpoint, of the attorneys like Joe, they're the captains of the ship and whatnot. But if you find that there is an earnout situation happening that doesn't happen, but it might be because the buyer perhaps affected certain customer relationships that went away. But that's a matter of liability, and I'm not an expert in liability at all. So I might have to do a lattice damage analysis, saying, all right, if none of this was realized because it's the seller's fault on the customer relationships, then here are the damages. If maybe half of those customers were lost because of actions of the buyer, then here's the alternative damage analysis. So it may not always be black and white that I provide one opinion based on the same bucket of damages, because there could be different buckets of damages depending on the representation.
And that's an important, as a litigator working with an expert, it's always helpful to have that approach if it's appropriate for that case, because these expert reports come in in the middle of the case, right? So while you're supposed to be done with your fact discovery, things happen, you end up learning more, and you don't want to get to trial and say, oops, I would have liked this sort of alternative approach, but now I'm stuck with what I have, which is all or nothing approach. If anywhere that you can have that approach is very helpful.
That makes sense, especially as companies become so large and complex and multinational. How long does this process usually take in this initial research into these different R&Ws or fraud?
I guess it depends, and that probably dovetails nicely into the survival period that we can talk about, which is a lot of these deals. And I'm focusing only on Delaware. I'm only licensed in Delaware. It's where a lot of the merger and acquisition litigation happens. We have a general statute of limitation of 3 years. So when the deal closes, essentially, when those reps are made, as a default, if you don't bring a lawsuit within 3 years, your claim will be dismissed as being barred by the statute of limitations. What deal lawyers have done, and I think it's smart, and they're taking the guidance from the courts here, who say, look, you can contract around the statute of limitations. You're sophisticated parties. So if you want to make them shorter, you can. If you want to make them longer, you can. So there's often this, I would also call it a latticed approach, Tom, to use your words. The survival period for a lot of these financial reps, like compliance with regulatory issues and laws and customer contracts, those are usually shortened. Like maybe 12 to 18 months is probably the most common survival period. What that means is 12 to 18 months after the close date, if you don't bring your claim, usually it's a claim for indemnification if it's not a fraud claim. If you don't bring it within the 12 to 18 months, you lose, it's done. It doesn't survive. There are other reps that are called fundamental representations that will sort of last at least the statute of limitations, sometimes longer. Those are often less litigated issues. It's something as simple as we have authority to sign this document and bind the company, we're in good standing, et cetera. And that's why I think parties are less inclined to shorten that survival period. So this gets back to your question. Because you had the survival period, it might be a year, it might be 18 months, you really need to start understanding and getting under the hood, so to speak, post-closing to make sure there are no issues. because that time will expire pretty quickly. And if you don't raise the claim, usually by a notice, with a letter to the counterparty, you're going to lose your opportunity to bring that claim. So it happens pretty quickly.
So it's just about bringing the claim. It doesn't have to go to court yet or anything.
Correct. You got it. Well, it depends on the language of the contract. I'll say that a lot probably today. Usually you have to bring that notice to their attention within that survival period. Some will say you have to bring the lawsuit within a survival period. It just depends on the wording. But if you do that, you're good. The case itself will last however long it takes based upon the court's availability, the complexity of the case, things of that nature. Most of those cases last, 2 years.
Oh, wow. Okay. So you're in it for the long haul, but it's usually a big haul.
And that's if you go to trial. Obviously you could settle.
So when we say go to trial, like what litigation arises related to R&W? What are the
You're proving, you're essentially saying, I'm going to exclude fraud. It gets more complicated, but essentially, I'll use the Durham Medic case as an example. I think that might be the best way to do it. This was a case decided last year by Vice Chancellor Laster in the Court of Chancery, and again, it was a medical supplier company. A private equity firm purchased that company, and they did it by a merger. And there were, I think, 2, if I remember, reps and warranty situations that were challenged by the buyer. Post-acquisition, the company performed poorly, and they looked into it, and there was a rep and warranty that the company had been in compliance with certain healthcare laws, and that it had not received written notice of alleged noncompliance from any governmental agency within a couple of years prior to closing, except for any specifically disclosed ones. You usually do that on a schedule. There was a disclosure of one, right? And then the merger closed, and then they discovered there were others. So that's what I mean. You discover that pretty quickly, and then you reach out to the other side and you open up a dialogue. For that, there's particular damage. You got to figure out, and this is where Tom would come in. For that, that's not like an earnout discussion. That is what harm occurred to the company because of these regulatory issues. And I think you'd have to to figure out how much money did you spend, probably, fighting some sort of prosecution or other investigation. Did that impact your revenue in any way? And so that's where Tom would do analysis. And then, so you would say, okay, are there any other reps and warranties that were breached? They discovered that there was this significant customer rep, which I think I raised, which is, hey, have any significant customers said that given notice that they're going to terminate or significantly reduce business? There, they said, I think they may have listed one, but there were others. There were at least 2 that were found to have given notice, right? And that was a breach of the rep. And there's a lot of other things I could talk about with respect to that case. I think the first thing is this issue of that's how you would get started. You would draft a complaint, and you would file it with the court, and then you'd be off to the races. The other side would try to move to dismiss probably, and then if you survived, you're going to go do additional discovery, which is looking at emails and taking depositions, hiring an expert like Tom for him once he has all of that information, because he can't really render an expert report until he knows the facts. So that we have to work to get that to him, and then he would work up the damage number.
How often does it change from an R&W or a misrepresentation or these different things to fraud? Because you don't always know at the start of this investigation that it's fraud, right? Does that make it a different court filing and you have to start over, or?
No, I mean, I think you really need to know on the front end, and it's hard sometimes, but you could certainly seek leave to amend in the court if you find something. So throughout the case, if there's some sort of like what I'll call smoking gun email, right, then you would seek leave to amend, and the court likely would allow you to do that. Oftentimes in the beginning, when you're approached about a case, the claimant wants to bring a fraud claim, because we didn't talk about this yet. These documents typically have a cap on liability, meaning it's some, and I think Tom can give you the numbers, but there's a percentage of the purchase price that's typical as a cap, or maybe the purchase price itself is a cap, something like that. Usually it's way less than that. If you think there was intentional misconduct or even recklessness under Delaware law, depending on how fraud's defined in the agreement, you want to get over that cap, because if you have a fraud claim, your damages are not capped as a matter of law. So you have to really know on the front end. Sometimes you have enough to say it was intentional, other times you don't.
Anything you want to add about that discovery phase and what you need and how you get that information, Tom?
Yeah, I think, we look at the information, let's say in this case, that one customer was permanently lost, but the representation and warranty said, hey, this is part of annual recurring revenue. So you can bill that into the earnings before interest, taxes, depreciation, and amortization, the EBITDA that you're going to pay a multiple of 7, let's say, on. And then when we find out, hey, that customer is just ready to leave, and you see all these communications and whatnot, and then we look at the invoices, the annual billing on that and whatnot, and then we look at seasonality and also economic cycles, because that customer may account for 20% of revenues in one year, and then economic conditions may make it 15, then 25. So we want to probably take an averaging process or a high or low, again, a latticed approach, and apply and say, what is the lost value? The lost value in certain cases, it will be the loss of permanent value. So let's say 7 times whatever the EBITDA that was generated by that customer. And maybe we'll do a discounted cash flow too. We have 2 approaches: the EBITDA multiples, the market approach; the discounted cash flow is the income approach. The 2 most commonly used methods in most merger and acquisition acquisition transactions. Other times there may be mitigating factors that occur where there's only a more narrow period of a few years, because there's mitigation that occurred. A new customer got onboarded by the company, because the defendant has a duty to mitigate and whatnot. So that may be a more limited amount of damages with lost profits.
Okay, so there's a lot. It sounds very much, you're talking lattices, but I'm hearing snowflakes here, that everything is very different and interpretable and different proof and money, right? Okay, so
It's
something.
complicated. Can I make a note on the multiple point, because I think it's important for deal lawyers and even private equity folks to know about. They're in that same Duramatic case. It's kind of interesting. It's a very interesting case to read. In that case, there was basically a 6.8 multiple, so close to the 7 that Tom uses as an example. What happened there on that significant customer misrepresentation or breach of rep and warranty? They did exactly what Tom said. The plaintiff said, look, we were damaged by the multiple that we employed to come up with the purchase price, and it was approximately 6.8 times EBITDA. The defendant, seller said, no, you can't employ that. You were only harmed by the loss of that customer, whatever that amount was, in revenue. And what the court did, the court said, well, the agreement itself, in the definition of losses, recognizes that, you could get damages for a multiple of revenue and other metrics. But it doesn't say in the agreement how to employ it and when it applies. So what the court said is, I'm deeming that to be silent. So we're going to look at common law. And common law lets you value on expectation damages, right? What did the buyer expect to get from this transaction versus what did they actually get? And to get to that EBITDA multiple, which the court ultimately gave to the plaintiff, he said, we need to look at the evidence. What the evidence showed, it wasn't in the document itself, is that the investment committee circulated a memoranda memorandum about employing this 6.8 EBITDA multiple to arrive at the purchase price. So there was evidence presented, and there was an expert that testified that said this is how we got to the deal price. So that was satisfactory to the court, even though there was nothing in the four corners itself. What I would, as advice to practitioners, deal lawyers, the way to deal with that on the buy side is to make it crystal clear. Just put in the four corners of the merger agreement or the stock purchase agreement that you valued the purchase price by a multiple of X on whatever metrics you're multiplying, and we came to this dollar amount. There can be no confusion then if there's a lawsuit that it was an EBITDA multiple based approach. On the flip side, if you're a seller and you want to avoid this enhanced damages, that's what I'll call it, you can try to put into the contract, obviously the other side has to agree, that a multiple of damages will not be employed if there's a breach, right? It's all about talking to each other and coming to a meeting of the minds. And if you can do that and there's more certainty, there's less litigation. What I often find is like people don't want to propose that, or it's rejected because they just want to get the deal done. So a seller might say, I don't want a multiple based approach. I want to put a carve out or an exclusion, but they still want to get the deal done. So if the other side says no, they're going to probably just cave anyway, right?
And desperate times leads to desperate behavior.
Or just, you've built the business and it's time for an exit, and you think it's a fair price. And honestly, you had a good relationship in the deal and you don't expect any problems.
Yeah.
But that's when problems arise. You never really know.
You never prepare for the end, even in discussing with some of your lawyer colleagues about wills and things and planning. You don't always, and companies that were built together and are suddenly separating, they can never imagine that, a divorce with a company either.
No one wants to look at my job is usually to say, what's the worst case scenario? You need to plan for that. No one wants to do that. And I get it. They're optimistic. And that's why they're successful transactional individuals, right? They look at the positive.
They're startup founders and things like that. Yep. Okay. There was something that we had said in the planning up that you described, Joe, Delaware as a contractarian state. And you talked about sandbagging and anti-sandbagging, and definitely the listeners want to hear what that means.
Yeah, I mean, it's so contractarian is sort of what I've been talking about so far, which is the words of the paper matter. The courts in Delaware will construe those things, based upon the intent of the parties if it's clear. And if you want to, like, for example, if you want to extend the statute of limitations, extend it. If you want to limit it. The court's not going to say, no, we're not allowing that. The sophisticated parties often put Delaware law into their agreements because they want the flexibility that Delaware allows commercial parties to employ. Part of that is this sandbagging concept, which is, it sounds like it sounds like a terrible term, but it's just the term that it's been given, which is, let's go back to the Durham-Medic because it talks about sandbagging. Durham-Medic, the regulatory piece that we talked about. There were notices about regulatory, inquiries by governmental agencies that the seller did not disclose. So what happened in that case is that during the due diligence, before the signing of the definitive agreement, there was a conference call, according to the post-trial opinion. There was a conference call amongst the parties where the seller disclosed verbally that there were additional inquiries by the government. Right? So when they were sued for breaching the rep, their argument was, well, we told you about it. So you relied upon that and you shouldn't be able to sue us, and you closed anyway. Delaware is a sandbagging state because too bad, you put in the agreement that there were no such notices. You're stuck with the words on a page.
Oh.
Right? And that's a risk. It's sort of the risk, you got to look at the risk and make a decision on what you put in there, and be careful about it, because the court's not going to make a counterparty dive into and go on an expedition to determine whether every single thing said in those reps and warranties is true. It sort of defeat the point, right? It's like, well, they told me this is true, I have to accept it as true. So that's Delaware's view on that. Now, there's, again, because it's contractarian, the state of Delaware, you could deal with this. You could put an anti-sandbagging provision in. I haven't seen them, but you personally, but you can put an anti-sandbagging provision in your agreement that would deflect what we just talked about. Saying, anything we told you, on a call or whatever, is fair game. You could also, on the flip side, put a pro sandbagging. You can, instead of being silent like most of these agreements are, you could say, look, you are stuck with the words on this page, and whatever we tell you in due diligence is sort of irrelevant to that. And so that's how you would deal with that. And there is, in the Durhameta case, there was a standard integration provision, which essentially says this is the final document. No other, documents or communications or discussions are the deal. This is the deal. And so that sort of bolstered the court's decision on the sandbagging point. For fraud, you would need more than an integration provision. You would need, to avoid fraud, you would need an anti-reliance provision that says, very strong, clear. We relied upon nothing other than the words on this in the four corners of the document. And if it's strong enough, you can dismiss a fraud claim for fraud. Usually in that scenario, the fraud actually has to be in the document itself. So the lie has to be in the document, because you can't go outside the four corners.
Okay. But then sometimes you're like, but it was a lie in the document, and then Tom has to go and figure out, is it a lie and how do you prove it? But I guess if it's written down, that does make it easier. So you want to be as detailed as possible, as thorough as possible.
Yeah, which can be tough because you're trying to anticipate the future. But with the fraud thing, Tom, it's, if it's fraud in the four corners, it's easier to hand off to Tom and say, look, they said right here, this is true.
Yeah.
We have facts, and here, Tom, here are the facts that show that it's untrue. Tom's not going to opine about causation and liability. He's going to say, assuming it's untrue, this is how they're harmed.
Okay, yeah. As we talk about the other side to incentivize the buyer, let's talk about earned out provisions and what criteria is met for this. How's that work?
Yeah, I think, Tom, that might be a good one for you. It's sort of more financial, but I'm happy to talk about it, but I want to give you an opportunity.
Oh, sure. And I think we kind of touched upon this lightly earlier in this podcast, but basically it's based upon the buyer and seller agreeing that, look, buyer, if you achieve this level of sales or revenues and profits, sometimes they put profits in it too, above and beyond a certain amount, then we will pay you additional consideration. And the consideration, it varies. There's so many different ways to structure these, but that's the basic way. But sometimes it's like, if you do it in 1 year, we'll give it, or 1 or 2 years, we'll give you X% of that revenue amount, or X% or a multiple of that profit amount. If you do it continuously for 5 years, we're going to have an even higher true up, because it looks like a permanent increase in value. So that's typically a very common structure that you see.
Is that usually tied in with like no compete clauses, or you cannot take these clients away, things like that? Are they typically tied to that revenue, that you cannot do something that harms the company that was just purchased?
Yeah,
The earnout's typically not tied to those, what we would call restrictive covenants.
Oh, wow.
Clearly, there's a natural practical effect. Like if important employees salesperson's leave and violate a restrictive covenant, you would value damage differently. Sometimes you would claim it's irreparable, right? So you're trying to seek an injunction of that competitive behavior, because it can be difficult. But with respect to earnout, you wouldn't tie an earnout to an individual typically. It would be very difficult to do that.
Okay, and then we have disputes that of course come with this as well. So I understand the reasoning because I work in tech, as many Delaware companies not surprisingly are. And this idea that you've built this company, you're ready to move on, but you've built this, so you want as some of the value to still earn for the next 3 years or whatever from it. But then disputes happen. So let's talk about those different disputes that happen in the earnout.
Well, usually the earnout's it's financial. So there's a target revenue amount, there's a target gross profits amount, and if you hit, there's different levels, right? There might even be a two-tiered approach. Like if you hit, $10 million of gross profit for a period of time articulated in the complaint, you get, another $1 million. If you hit 20 million, you might get an extra $3 million. I'm making up numbers, but it's really just you're getting less cash up front as a seller, but you're selling to a buyer that you believe is going to actually increase the footprint and profitability of the company, and you're hoping that you can ride that wave.
Yeah, in fact, the earnouts, prove me the value that you originally wanted, for me to buy in, for the buy-in, because you're negotiating. Buyer wants, to buy at a certain level, seller wants to sell at a higher level. So it's kind of like, well, if you prove it, then seller, you get this additional earnout. And the damages in those cases are much more mechanistic, as you probably can see, because you have these targets and whatnot in calculations versus, let's say, our earlier discussion on a loss of, let's say, annual recurring revenue. You lost one customer. Now, how does that reverberate into economic damages? And it often takes a latticed approach, as we discussed.
Okay, and then when litigation changes in there, where are the instances that change the whole litigation process and make it less straightforward, mechanistic?
Yeah, I mean, there's always something that spins a case into being less mechanistic, but I would say the earnout stuff is pretty mechanical. The numbers are. It's really about whether there was liability or not. I mean, liability is less important because it's like, did you hit a trigger or not? But going back to what I said earlier, did someone manipulate numbers? Did they purposefully avoid the earnout? Because what happens is if you claim you're entitled to an earnout, it can be difficult as the person who sold, being on the outside of the company, to even know whether the earnout was met. You have to rely upon statements that the contract requires are provided to the buyer on a quarterly, annual basis, whatever you agree to. Hey, send me that financial statement so I can see whether the earnout trigger was met. Well, you're getting a piece of paper. You don't really know what underlies that. And so it can be difficult to know, okay, well, on the piece of paper, it's saying I don't get the earnout, but there's something that leads me to believe that there's some, funny business, for lack of a better term, going on. Usually it's, you ran that business for so long, you knew you were going to hit that target, and like something really drastic had to happen for it to be diverted another direction. Or maybe there's even, you still are friends with high-level employees, and maybe they shouldn't be talking, but they're talking, and they're saying, look, we had a great year. I can't believe we didn't meet the earnout. That's where it gets a little bit dicey. If you're just in a straight earnout fight where you get the statement says earnout was met and the other side refuses to pay it for some reason, that's less complex.
And in a contractarian state, what a great word. What should people be doing ahead of time to not go out of the four corners, as you've been saying, and to not meet this? What should they be preparing better when they are doing the mergers and acquisitions?
Well, I think if you hire sophisticated deal counsel, they know that. I mean, even non-Delaware lawyers, because folks that practice all over the country or even internationally, they tend to follow Delaware law on this, and there's other states that are very similar. They know this stuff. But, you know, staying up on the case law and understanding how the courts are looking at these things are helpful. And I think just put everything you want in your agreement in a crystal clear way. I think we sometimes write these things as lawyers and we use legalese that is unhelpful. I just think it gets complicated. And sometimes the best thing to do is to simplify your language and make it clear. It's easier said than done because I'm a litigator and not a transactional lawyer. But you know, when I'm looking at it, when things go wrong, I'm often scratching my head as to why something was phrased a certain way when it could have been simpler. But that's again 2020 vision. So maybe keeping that in mind and just being open and upfront with your counterparty about it. Again, easier said than done. But I don't think you're ever going to eliminate entirely litigation risk in these deals. But good counsel really matters.
And is there anything contractually on the financial side that companies could prepare better to protect themselves on either side, whether they're a buyer or a seller?
Well, if I could put my merger and acquisition financial advisory hat on for a second, I think you want to have a very good reputable financial advisory firm conduct a very incisive quality of earnings analysis, where you look at typically the last 3 to 5 years of operations, and you adjust earnings for non-recurring events, for customers that aren't annual recurring revenue, and that really drives an analysis, right? Is if you're looking at the ARR, that's the financial analysis of that is the quality of earnings study.
Okay, so don't try to rush it. You're going to make a rash decision that is not going to lead to happiness in the end, even though you might get that rush of money in the beginning. So try to protect yourselves, and if it takes longer, it takes longer. So how do people get in touch with you to ask more very specific questions to their business, which I'm sure they have? Joe, do you want to go first?
Yeah, for me, I mean, you can email me at cicero@chipmanbrown.com or go to the website chipmanbrown.com and you can find my bio there. My phone number is listed as well. I'm pretty responsive.
Pretty much the same thing. If you Google my name and put dash business valuation, you pretty much get to me. Or if you just want to go to Sanli Pastore and Hill's website, www.sphvalue.com, you'll see my email. Email is a great way to contact me, but I also have my phone numbers.
Okay, that's great. Yeah. Nobody loves an unplanned phone call. It's better to have a planned phone call, in my opinion. This was great. Thank you so much for teaching myself and the learners so much. And I'm sure a lot of startups, scale-ups, and enterprises are going to listen to this, go slightly cross-eyed, and then say, oh no, something's going to click that they need to talk to a trusted professional like you too. So thank you so much. And thank you to listeners. If something was helpful in this conversation, I'm sure you know somebody that could use it. So please share it with them. Thank you.